Hi, I'm James Robinson, and this is my stock thought of the week. In the play The Tempest, Shakespeare wrote, "What's past is prologue." That saying has always resonated with me, and what it really means is that if we think about what's happened in the past and we study it and understand it, it will set the context for and often explain what's happening today. And so in light of that, I want to do a video today which is going to talk about the Nifty 50 and compare it to the S&P 500. I think there's a lot of parallels and correlations between the two. I think if you learn what happened in the Nifty 50 and apply it today, it might make you a better investor. So this is going to be a pretty long video because I want to cover some things and I need to do some history to get you up to speed on why I'm saying these things. Hopefully you'll spend the time and watch the whole video. One of the first concepts I want you to understand is that Wall Street does not do things for you. Wall Street does things to you. They don't pay all those MBAs and PhDs to figure out how to make you money. They pay all those people to figure out how to make them money. And so what they will do is they will take facts and they twist them around, and they then make arguments from those facts which lead you to the conclusions that they want you to draw, and those conclusions inevitably put money in their pocket and not yours. And so when looking at the S&P 500 and how that evolved from the Nifty 50, you'll see that the changes that they made and the decisions that they made in setting up the S&P 500 index funds were changes that were made to benefit them, and that as an investor, if you're not careful, you can fall victim to some pretty ugly situations. So first, I think I should start by explaining to you what the Nifty 50 is. It's something that some of you may never have heard of, many even. In the 60s and 70s, they developed an informal list of 50 popular large cap stocks that were regarded as high quality, buy and hold type growth stocks. And these companies, these 50 companies, became known as the Nifty 50. There was never really a formalized list like there is with the S&P 500. It was really just a sort of, these were kind of basically agreed to be the Nifty 50. And your 50 companies might disagree with mine. There might be 3 that I had that you didn't have, for example. But basically it was these 50 companies. You can see here's what sort of Wikipedia has called the components of the Nifty 50, and it's probably as good a list as anybody's. And many of these companies are still, household names: 3M, Coca-Cola, Anheuser-Busch. Right? Anheuser-Busch, of course, is merged and is no longer Anheuser-Busch, but the Walt Disney Company and a number of others. And others of them are gone and they don't exist anymore. But you get the idea. These were sort of the biggest companies of their day. They were very well-run companies. They were very well-managed companies. They were generally profitable companies. And so they made a very safe list of companies that a stockbroker could advise his clients to buy. And the idea of the Nifty and the Nifty 50 was that a client would come into a brokerage and was looking for investments. And a broker could suggest a portfolio made up of these stocks, and really any of these stocks in any order, in any distribution, in any percentage, would probably be a pretty reasonably safe portfolio that the broker could suggest you buy because you're buying these large companies. The other thing is that it was pretty defensible. No one was going to look at your picks and say you were crazy for suggesting this stock. How do you tell somebody they're crazy for picking Disney or Coca-Cola, for example? The other thing that happened is over the 60s and 70s, these stocks performed well. And most of them performed well not only in their own merit, but they performed well because they had the cachet of being part of this Nifty 50. Again, we need to put some context here. Wall Street was a different place in the 60s and 70s than it is today. What would happen back then is a broker, an individual guy, would go out and he would either cold call or network and get a number of clients. And he would then try and convince those clients to buy stock. And he did that because he was getting paid a commission on the stocks. And it was a very lucrative business. You made about 80 cents per share when you were a broker. That was your commission, 80 cents per share in the 70s. And when you think about that, that's a tremendous amount of money, considering that today you can buy it used to be you could buy an unlimited number of shares for $7 or $8, and now brokerage companies consistently don't even charge any commissions. So it should give you an idea of how much things have changed. But to put that in perspective, if you were a broker and you had a client with a $50,000 portfolio, and you could convince them to, over the course of a year, just change half of the portfolio. So you sell, these number of stocks and you buy that number of stocks over the course of 12 months, then that would equal, assuming that the average stock was $20 a share, that would mean that client, that individual client, generated about $2,000 in commissions for you and your firm. Now, $2,000 in commissions in 1970 was about $13,000 today. So you can see if you had 30 or 40 clients and you're making $2,000 per client, sometimes 30 clients would be $60,000, but that's really $400,000 or $500,000 in today's money. So it was a big, very lucrative business, provided that the broker could get you to occasionally change your stocks. And that's one of the places where the Nifty 50 came in. So imagine you're a pretty good golfer and you spend a lot of time, you're a nice guy and you spend a lot of time at the club, and over the course of years, you meet a bunch of guys and some of them have some money and they decide to invest their money with you because they like you and they trust you. But let's also assume that you're not really hardworking and you don't really understand the brokerage business and you don't really analyze stocks. What do? Well, what you would do is you would simply pick and choose whichever of the Nifty 50 were in vogue that day, or that week, or that month, and tell your client to buy that stock and to sell whichever one you thought was the least attractive. And you do that every few months, and that's how you would get your churn. You wouldn't have to really understand the market. You wouldn't have to really understand companies or analysis or value investing. As long as you stayed with these 50 companies, it was sort of an entirely defensible suggestion, and you got your commissions. So in general, this strategy worked like a charm. The brokers obviously made money because they got all the trades, as did the firm that they worked for. And the clients actually made decent amounts of money because during the 60s and 70s, again, we're going to talk about this later, but these companies performed well, both based on their own merits and based on the fact that they were part of the Nifty 50. And so what happened was other brokers saw the brokers who did this being successful in garnering new clients, having clients invest more money, and playing a lot of golf and not working very hard. And so it was replicated. And what's really kind of a virtuous circle about this was that the more it was replicated, the more other brokers told their clients to put money into the Nifty 50, the more that had an impact on the value of those companies and the PE ratio of those companies, because the PE didn't go up, or the earnings didn't go up, but the amount of money trying to buy those stocks went up every year. And so it was a great virtuous circle for everybody. However, and those were very large companies, so they could do this for a number of years, and the additional money put in by these investors didn't materially change the price of the stock at first. But over time, the amount of investment put in by people buying the Nifty 50 started to dwarf the size of the market caps of these companies. And so the PE ratios went up sort of year after year after year, gradually at first, but it accelerated over time. But again, no problem, because the more the PE ratios went up, the more money that was invested, the more everybody thought this made sense. And so again, the circle just continued to feed on itself. But at some point, the price of the stock could no longer be justified by the earnings, and still people kept buying. But obviously at this point, we're in bubble range, right? The price of these stocks is now a bubble. Just to put it in perspective, in the early 1970s, the average PE of the Nifty 50 had ballooned to 50 times earnings. And if you spend any time understanding stocks and understanding companies and the way they grow, these very, very large companies were not going to be able to sustain a PE ratio of 50 for very long. Something was going to happen. So what you have to understand is that what was happening here was great for Wall Street. In the 60s and 70s, Wall Street made money through brokers selling shares to individuals. They did not make money when their investors made money. They could care less if you made money. The only reason they liked it when you made money is because it tended to make you want to invest more. But generally speaking, they only cared about that you were buying stock. And if you were selling stock, buying some other stock, and that's getting 2 commissions instead of 1. So Wall Street did what it took to induce transactions. And if you don't believe that, look back at what happened in the 60s and 70s and 80s with stock splits. See, it was in the broker's best interest to have share prices as low as possible. That way, there was more shares being traded, and more shares being traded meant more commissions. And so if you look at the number of stock splits back in the 60s and 70s and 80s, and you compare it to now stock splits don't happen hardly ever. They're very much more rare. And the reason they're more rare is because there's no brokers pressuring companies to reduce their share price. If you want to buy $10,000 worth of Apple, for example, what do you care whether you get 10 shares or 100 shares? You've got $10,000 invested in Apple. But back in the day, in this time frame, brokerages and the big Wall Street companies were constantly telling their clients, we should split this stock whenever they could justify it, because then they'd make literally, if they 2-for-1 split, they make 2 times as much money every time they told a client to invest in the stock. And in fact, there's even cases where the brokerage companies would reward companies, if you were to split your stock, we'll make sure you get more transactions, which will increase your stock price. So that's the kind of things Wall Street do that was sometimes subliminal and sometimes overt to encourage companies to do things that was good for Wall Street. So one of the things that they decided is if we kept people buying this Nifty 50, stock price is going to go up, but it also covers our mistakes. We don't have to be as smart. If we can convince everybody buying these stocks is safe and everybody buys these stocks, then when it goes south, it's sort of, well, who could have predicted a market going south? We know these are great companies. And that's really what they were doing. So in terms of how bad it got, first of all, this is a slide from a video that Manesh Prabrai did. And for those of you who don't know, Manesh is one of the guys, one of the sort of the famous value investors that maybe if you're not a deep value investor, you've never heard of. But if you haven't heard of him, you should read his book, The Hondo Investor, and you should watch all of his videos. He's a very, very bright guy. So he did this thing, so I've stole this, but hopefully he recognizes I'm trying to give him credit for it. Anyways, if you look at these are the PEs in 1972 of 9 of the companies in the Nifty 50. And you see Disney was 82 times earnings, McDonald's 86 times earnings, Polaroid at 91 times earnings. These kinds of earnings these kind of PE ratios are almost certainly not sustainable, right? Not very many companies can justify it. And this should have been a red flag to investors that, hey, we need to get the hell out of here. But the problem was that the market had convinced people this Nifty 50 is just always going to go up. And they'd been right for 8 or 10 years. So why would you run away from it? We're all making so much money. It's party time. So that was in 1972. In 1973 to 1974, the market crashed. At first, the Nifty 50 was sort of immune to that crash. Everything else sort of went down significantly, but the Nifty 50 kind of held their value. And that's why the crash took so long. It wasn't sort of an instant overnight crash like we had with the drop in due to COVID. It was very much a slow motion thing. But what happened was eventually over the course of 2 years, every one of the Nifty 50 companies, to quote Manesh, was taken out back and shot. And you can see Polaroid lost 90% of its value, Avon 85% of its value, Coca-Cola 75, Disney 75, Xerox 71. I mean, imagine 75% of the value of Coca-Cola is wiped out over 2 years, and you've been a stockholder who doesn't know very much about businesses but thought you were safe because you were buying this Nifty 50. And that's the point that I want to make, is there is a point where even good companies can't justify the price. The price in the short term, according to Warren Buffett, is defined by a popularity contest. The more people that like the stock, the more money that it's worth, everything's great. But in the long run, and the long run is sometimes several years, the company will revert back to its actual value. And in the long run, the market goes from being a popularity contest to a weighing machine. It simply says, what's the real value of this company? And that's what the price eventually goes to. And in the Nifty 50, what we saw is a bubble that took about 15 years to happen, 12 to 15 years. And we saw that these companies that were otherwise fantastic companies got very, very bloated because there were too many people trying to buy them. And even though they remained fantastic companies, Coca-Cola was a fantastic company through this whole thing. But at first it got too expensive, and then it got hammered and got back to somewhere between reasonably priced and slightly underpriced. But again, the value of the company didn't change, just the value of the stock. And the Nifty 50 blurred people's impression as to what the stock was really worth. And what I think I'm going to be able to show you in the rest of this video is that what happened in the Nifty 50 is exactly what's happening to the S&P 500. So I've talked about how the crash was inevitable, but one of the things that's really interesting is this 2 or 3 year crash where everybody's unloading all these stocks was still a reasonably profitable period for Wall Street, because they were making 80 cents a share, and everyone who sold a stock had to pay, the brokerage companies for the privilege to do so. So yet again, the goals and objectives of Wall Street were not aligned with the goals and objectives of their customers. And the ones who lose always seems to be the customers. You don't really want to be the customer in this equation. But having said all that, the status quo still wasn't perfect for Wall Street. What had happened with the Nifty 50, they learned some lessons, they went to school and they thought about it, and they come up with some plans for what do we do to make sure we can get our investors' money even easier. So after the crash of 73, 74, Wall Street went back to school and studied and tried to figure out what they could do better. They didn't try and figure out what they could do better for you, the investor. They tried to figure out what they could do better for them, right? So in hindsight, there were several costs associated with the current model that were suboptimal. The first one is, in order to sell all the stocks with the old model, you needed brokers out there golfing with their buddies and cold calling, trying to generate customers, and then they could sell those stocks to the customers. And in exchange for that, they were doing these commissions, but most of the commissioners would go to the stockbroker, and comparatively little would go to the firm. And so brokerage companies decided, we don't really like that. We should get rid of the broker. If we can get rid of the broker, we're going to be a lot better off. And on top of that, if we get rid of the brokers, we get to get rid of the offices. And these offices were very opulent. Brokers had to look respectable and credible, and so they were always in great buildings. They are to this day. I mean, go look at a Merrill Lynch office anywhere in America. It's in a great building, it's in a great location, and it's got tremendous build out to look like it's very successful. On top of that, they had lots of high-paid support staff and all of the problems that go along with all of those people and all that staff and all that marketing. And on top of that, they needed activity. They needed people buying and selling shares constantly. And so they were constantly trying to get people to churn their accounts. And at the same time, they recognized that a buy and hold strategy seemed to get better results than all this churning, but they couldn't make any money if anyone actually believed that. And so they didn't really push that as hard as they should have. They knew that they would go broke if everyone did buy and hold because there'd be no fees. So in the face of all of that data, along comes a guy named Jack Bogle. Jack Bogle founded a company called Vanguard, and Vanguard's initial biggest product or big product, which became their biggest and is still one of the biggest, is called the Vanguard Indexed Fund. And so an index fund is where you simply buy, instead of buying a stock, you buy a set idea of companies. In this case, the index fund was the S&P 500. So you simply bought what was represented by the S&P 500. Now that differed from mutual funds. Mutual funds bought a whole bunch of stocks, but it was a curated list by some star manager. Which star manager was paid these gigantic fees? And the argument that Jack Bogle came up with, which was very brilliant, was if I don't have to curate those, I don't have to pay a star investor, then I can get the fees very much lower because I don't have any of those costs. And all of those profits really can come back to me, the fund manager. And so one of the things that they did to convince people to do that, or one of the things they took advantage of to convince people to do that, was that there was such a thing as the efficient market theory. And the efficient market theory is pretty simple. What it basically said is all of the information which is important to the value of a stock is knowable by the general public. And therefore, all stocks are always priced basically at their fair value because the market knows so much about the stocks that it won't be overpriced. Now, I think that's ludicrous in hindsight. I think that intelligent investors, especially value investors, would say that's absurd, but there's still a number of people who believe this, and it's still being taught in finance schools today. So the idea of the index fund was really simple. You can't beat the market, not in the long run. So some mutual fund might beat the market this year, but next year they won't. So if you can't beat the market, then you should just invest in an index fund. And if you do that, then you save all those high price fees for the star manager and other issues, and therefore you're going to outperform these mutual funds. So that was sort of the idea. How we will also see is that unspoken in the brilliant argument is that at the end of the day, they were really just recreating the Nifty 50, but they were doing it in a way that included no stockbrokers, convinced you to buy and sell, and didn't require the churning that was happening before because they were getting a flat fee based on the total amount that was invested in the fund. In my opinion, one of the giant problems with the S&P index fund, and one of the things that's creating the issues I'm going to get to later, is the system of weighting. So I think what most people believe when they buy the S&P 500 is that they're getting basically equal shares of all 500 companies, right? If you invest $10,000 in the S&P 500, then you're going to get basically $20 invested in 500 companies. You're going to be totally diversified in your portfolio. And that's what makes the S&P 500 so wonderful, is this tremendous amount of diversification. But what's interesting is that Wall Street hates that idea. Wall Street was never going to let you do that. And I'm going to explain why. Let's assume you want to start an index fund based on the S&P 500. The fund would then have a limit as to how big it can get. And the limit would be that with a weighted fund, the limit is much higher than it is with a balanced fund. Since Wall Street makes more money off the size of the fund, you can guess which way they choose. So in a balanced fund, not as much money can be invested in the fund as it can be in a weighted fund. Since Wall Street is making money on the percentage of money invested, they were always going to design these funds in a way that allowed them to have the most possible money invested in the fund. Let me go further into depth on that. In a balanced fund, the theoretical cap would be the amount of the market cap of the smallest company in the fund. So the smallest company in the S&P 500 is Under Armour. Under Armour has a value of about $7 billion. So in theory, if you had $7 billion invested in Under Armour, you could not then invest another penny in Under Armour. And since you've got an equal amount of every stock, then you'd have $7 billion times 500 stocks, or $3.5 trillion would be the absolute most that you could be invested in these S&P index funds. Now, Wall Street doesn't like that. Wall Street wants to invest more in these funds. In fact, today, there's $11.5 trillion invested in S&P 500 index funds. So what did they do? Well, what they did is they weighted it. So what Wall Street did to get around this is, instead of making it a balanced fund, they made it a weighted fund. They put much more money into the largest companies than they put in the smallest company. I mean, dramatically more money. So let me just give you an example. So if you invested $10,000 in the S&P 500, you'd be buying 505 stocks. It's actually 500 companies, but there's 505 stocks because a couple companies have multiple classes of stock, right? Under Armour has 2 classes of stock, for example. But so anyways, you'd have bought $10,000 of your stock. Instead of getting $20 in all 500 companies, which is $10,000, with the weighted position, you actually would get $654 of Apple, $514 out of 10,000. $514 would be in Microsoft, $420 in Amazon, $206 in Tesla, $199 in Facebook, and on down the road, every company having a little bit less invested in it, until we get to the bottom 5 stocks. In the bottom, the number one smallest stock, you'd have 69 cents invested in that company. So out of your $10,000, you'd have 69 cents in the smallest company. You have about $4 in Under Armour, $3.81 in Harley Frontier, and $5 in Xerox. So the bottom 5 companies work out to less than 0.05% of your $10,000. To look at another way, what's really scary about this is those top 5 companies have an average PE of 341. That's right, 341 is the average PE for the 5 largest holdings of the S&P 500. Now, you're going to argue that Tesla is one of those 5 and it trades at 1,500 times earnings, and so it shouldn't count. But the fact is, it counts. I mean, if you invested $10,000, a significant portion of that $10,000 is invested in Tesla. And to simply ignore that company's trading at 1,500 times earnings doesn't strike me as a reasonable argument that you should do. But even if you did that, even if you ruled out the impact of Tesla on the S&P 500, you'd still have an average PE of 47 for those 5 companies. So that's a really high. Remember, we talked about that right before the crash with the Nifty 50, the PE ratio was about 50. Well, all of a sudden with the S&P 500, with the top 5 holdings that you have, you've got a PE ratio of 341. And even if you decide to, for some crazy reason, think it's okay to rule Tesla out of that, you still have a PE ratio of 47. Another thing to think about, the bottom 116 stocks in the S&P 500 make up a smaller percentage of the holdings than Apple. So the investment you have in Apple is larger than the investment you have in the bottom 116 stocks. It takes about 274 stocks, so more than half of the stocks, to equal the total amount that you have invested in the top 5 holdings. So again, you've got this idea that you're really well diversified when you buy the S&P 500, but you're not. Significantly more of your money goes into the very top few stocks that go into the bottom 275 stocks. That's kind of untenable, but most people don't know that. Wall Street doesn't want you to know that. Wall Street doesn't care about you. Wall Street wants you to be able to invest $11 trillion in these funds, and if it's a balanced fund, they can't do that. Another thing to put in perspective, again, looking back at how the S&P 500 is similar to the Nifty 50, the 50 biggest stocks in the S&P 500 are far more than half of the value of the S&P 500. So 50 biggest stocks are more valuable, of a higher percentage of your portfolio, than the next 450 stocks combined. So we've now talked about the weighting and how the weighting doesn't give people the diversification that they think they're getting. The other thing you gotta understand is that as these top companies become bigger and bigger, and more money flows into the S&P 500, which then distributes that money and buys ever larger proportions in these bigger companies, the bigger companies get ever more bloated. It's sort of this, again, virtuous circle, and I say virtuous loosely, of a self-fulfilling prophecy. Look, index funds were good for investors for a very long time. They made it so that you didn't have to be really smart. You could grow, you could benefit from the growth of the American economy without much risk, without paying large fees. In all those ways they worked. And for 20 years or 30 years, Warren Buffett has been telling people they should buy them. I wish he would stop. I wish he would recognize now that these are starting to become indefensibly high-priced companies in the S&P 500, and that one of the major reasons they're so high-priced is exactly because of the S&P 500. Consider that all of the money that's in the index funds is invested as stupidly as possible. What I mean by that is it's dumb money. It does no homework. It does no research. It simply says every time I get $1,000, I have to put a certain amount into Apple, a certain amount into Tesla, a certain amount into Chevron, and a certain amount into Under Armour. It doesn't spend any time thinking about if any of those companies are good companies or bad companies. It doesn't worry about the debt. It doesn't worry about the business model. It worries about nothing. It's dumb money just getting thrown in there by some preset equation. Look at this another way. The market cap today of all 500 S&P companies is roughly $30 trillion. So that's the total value of all of those companies. But we know just over $11 trillion is invested in S&P index funds. So what I'm telling you is that one out of every $3 comprising the market cap of the S&P 500 is the dumbest money possible. It has done no research to decide to buy these companies. It is simply buying it because it's an index fund and that's what it must do. It's literally a robot. And that should scare you. You're not significantly more diversified with the S&P 500 than you were with the Nifty 50. A third of the money being invested in these companies is dumb money. And the S&P 500, so one of the things that's happened with the S&P 500, why it's performed so well is, again, the economy has generally done well, which means these stocks generally become more and more profitable, which means their stock prices generally rise. But on top of that, more and more money is being thrown in chasing these stocks, which has artificially caused them to rise higher and higher. And so it's this self-fulfilling prophecy we saw with the Nifty 50. Up until 1972, everybody thought this was great and nobody cared. And again, Wall Street will never advise you that you should be thinking about this because Wall Street is making its money from the fact that you buy and hold the S&P 500. There's $11 trillion invested in S&P index funds. That $11 billion throws off, depending on what study you look at, something like $22 billion to Wall Street. Do you really think they're going to tell you to get out of those stocks, get out of the index 5 funds when they do absolutely no work to earn that $22 trillion? They do nothing. They just get to cash the checks every year. And so they're never going to tell you that you should be thinking about this, but I believe you really should be. So how can we determine somehow how bloated this fund might be? We really can. The S&P 500 has historic PE ratios of around 20. So the average PE ratio of the companies in the S&P 500 has been around 20, basically for the entirety of history. That's a number that made sense as an investor. So let's look at this chart. And you can see here again that the 20 point is sort of the high point for the S&P 500 up until around, 2020, let's call it 2020, till around 2000, maybe even 1995. And since then, it's spent a lot of time above that. But the higher it's got above that, the more steeply it has dropped and the more quickly it has dropped. And while the S&P 500 isn't at the point of no return yet, it's very quickly going to be. It's at about 40 times earnings now. And when you look at it, anytime it's about 40 times earnings, it's set for a pretty significant drop. The other thing I'd like you to think about is the context of risk reward. So we know that the reward, if you invest in a stock, is that it could go up and you could make more money. We know that the risk is that it will go down. Well, if you look at the value of a company and you say, look, once a PE ratio reaches 40, it's much more likely the company has downside to go from 40 to 20 or 10 times earnings than it is to say the company could double and go to 80 times earnings. And so you've got this situation where the risk reward of holding really high PE companies just gets really hard to sustain. Now again, you can get away with it with some companies. If you had bought Microsoft's been such a great company over its entirety, you might do okay buying it, even at 80 times earnings and just waiting, and it'll kind of reward you. But we're not talking about Microsoft. We're talking about 500 companies in all kinds of industries. Many of them have no justification for being at 40 times. Many of them are in industries that are getting gobbled up or going away or being outmolded. And yet they still on the average have this PE of 40. And I think the risk that it's going to go down to 15 or 20 is far greater than the reward that it might go up to 60 or 70 times earnings and hold it. And the idea that you're going to know when to sell when it gets up to 60 times earnings is a joke. So again, if you look at risk reward and you look what's happening in the S&P 500, I think it's reasonable to assume that most of these stocks are really overpriced. So again, I don't want to be doom and gloom. I'm not suggesting to you that you should sell everything. What I'm suggesting to you is that you should be taking this data into account as you're trying to decide what your next investment's going to be. And if your next investment is one of the companies in the S&P 500, then I would look at this and say, when the market turns and money starts to get pulled out of the S&P index funds, how will that affect your company that you just decided to buy? Again, there's always opportunities. There's going to be great opportunities. And by the way, if the market turns, there's going to be fantastic opportunities. I just think there's more opportunities right now in companies that are not in the S&P 500 because I think those companies are also bloated. Just to give you a sense, the top 50 companies in the S&P 500, so again, that's the equivalent of the Nifty 50, right? It's more than half of the value of the index fund. And it's very large growth companies that, again, with an index fund, you're expected to buy and hold. So the top 50 companies in the S&P 500 has a PE ratio of 68.1. I mean, that's almost 150% of how high the Nifty 50 was when it crashed. Now, again, there's an argument there that you could make that Tesla has really skewed those numbers because it's a 1,500 times earnings. Okay, fine. Even without Tesla, the PE ratio is 36.9. And again, I don't think it's reasonable to rule Tesla out because it is a major component, a far bigger than average component in the S&P 500. But another thing to look at, even if you ignore Tesla, is that 17 of the 50 companies in the S&P 500 have a PE ratio over 40. So that's 34% of the S&P 500 have a PE over 40. 9 of those companies, or 18%, have a PE ratio of over 50. And to contrast that, only 6 companies have a PE ratio of under 20. So 6 companies could be argued to be in the range that the average company was, in most of the history of the S&P 500. And again, I think that should give you pause. I think you should consider that Wall Street is never going to tell you that you should get out of these stocks. And neither is CNBC or anybody who makes a living through Wall Street advertising. But I think if you just look at this in the cold light of day and you compare what happened with the Nifty 50 and you compare what's happening today, you're going to say, man, there is something that's pretty fishy here. It's like if you're standing on a beach and all the water runs out. Well, if you've never seen or heard of a tsunami before, you just think it's really interesting. But after that Christmas Day earthquake and the tsunami that followed, now all of us know, hey, when you see the water run out like that, that's a pretty good sign a tsunami's coming. It's time to get up, as high as possible. And I really believe once you look at what happened with the Nifty 50, you're going to say this is a tsunami brewing. I don't know whether this is going to happen this month or even 2021 or 22. I'm simply saying I can put my investment dollars anywhere I want. There are thousands of public companies. And should I be focusing on S&P 500 companies, or should I be focusing on much smaller companies that aren't exposed to this kind of bloat? And for me, it's pretty simple. I think we should try and avoid these companies with this giant bloat. So here are sort of my conclusions. The current S&P 500 is basically just the old Nifty 50 updated and improved for the benefit of Wall Street. I really do believe that that's what that is. We know that eventually the Nifty 50 got so bloated they could not sustain its values, and we know that it crashed. And we know about the point that it crashed, and we know why that it crashed. We know the S&P 500 is getting to be equally bloated. I think that that's incontrovertible. I also think that's a major reason why I can't do videos for you every week, because I can't find stocks that I think we should be buying. They're just too high priced relative to the earnings the company can create. So I think what we ought to be doing is we ought to recognize where we are. We got to stay patient, keep our powder dry, continue analyzing companies, trying to figure out what we think the real value of companies is, and then wait for the market to adjust to allow us to buy those companies. You don't have to be buying and selling stocks all the time. It's okay to have cash and it's okay to wait. The goal is to die rich. The goal isn't to be rich tomorrow. And one of the ways you do that is by not being heavily invested when the timing is wrong. So what I'm going to do is I'm going to continue to analyze companies, and I'm even going to continue to analyze S&P 500 companies, because I want to understand who the great companies are, so that if things go, pear-shaped, to use a British phrase, I know which companies I want to buy. But I'm also going to start investing a lot more time in investing, and start analyzing Russell 2000 companies or S&P mid cap and S&P small cap companies, because those companies don't have nearly the same amount of bloat. So that's basically the video. That's my kind of me being on a soapbox about where the market is and why I think the market's there and how I think that history can guide us, and where I think I'm going to be focusing my energy for the next 12 or 18 months until things sort of make more sense to me. Thank you very much for your time, and I'd love to hear your comments. Thanks.